Welcome back once again. This is, like I promised, this is the subsequent video on financial management, I did a video earlier on understanding the basics of financial management, financial planning. We solved some important questions. So if you haven't looked at that video, please go check it out. I would advise that to receive and be notified anytime I post a lecture, please subscribe to this channel. The subscribe button is the red button that you see, and hit the notification bell so that anytime I post a video, you would be the first to get it. You'll be the first to get it. And then you can pass your exam with ease. So let's dive into the slides right away. So measuring the achievements of corporate objectives. So financial performance has to be measured. It helps the organization to track its progress financially. And it's also necessary to find ways of measuring the progress of an organization so that basically, managers can know how well they are doing. You always want to know how well you're doing. And you can't find out how well you are doing except you measure. And a common way of doing this is through what we call ratio analysis. And ratio analysis is one of my favorite topics personally on financial management, ratio analysis. So ratio analysis is used to measure financial performance. So there are broad categories of ratios, right? Broad categories of ratios. There are profitability ratios. There are gearing ratios, which relate more to debt. In the past lecture, I told you that gearing relates to debt and leverage. Then you have liquidity ratios, which relates to cash. And we have shareholders' investment ratios. So these are the four categories: profitability, gearing, liquidity, and shareholders' investment ratio. And shareholders' investment ratios. So I usually use an acronym for this, which is GLIP. So G stands for gearing, L stands for liquidity, and then I stands for investment ratios, and P stands for profitability. GLIP or LIP-G, any way you want to remember it. So let's move on to the next slide. So the next slide, we are going to talk about profitability ratios, right? So under profitability ratios, you cannot assess profit or profit growth without relating them to the capital that you employed. Capital that you put into the business is very, very important when you are doing profitability analysis, because you need to know how much you put in so that you know how much, it becomes easier to know how much you got out of what you put in. I hope you get the picture. So it's always important to know the capital you employed in making the profits, the capital you employed in making the profits, or the investment, or the investment. So very, very key. And when we talk about capital employed, I explain what exactly that means. So the most important profitability ratio is what we call ROC, which is the return on capital employed. You can also call it ROI. ROI is usually the usual name that is used, the common name that is used, which is return on investment. So let's look at ROC, return on capital employed, and exactly the formula to calculate this. So return on capital employed is simply your profit before interest and taxes divided by your capital employed. Like we said, you cannot calculate profit properly, or you cannot assess profit properly without relating it to the capital employed in making the profits. So your return on capital employed is simply your profit before interest and taxes divided by your capital employed. Your profit before interest and taxes is simply operating profits, the profits that you earn from your day-to-day activities. You put in the capital also to make money on a day, make money through your day-to-day activities. So it's only fair that you use operating profit. So your operating profits divided by your capital employed. So profit before interest and taxes divided by your capital employed. Very, very important. So your capital employed is simply your shareholders' funds plus long-term liabilities. Shareholders' funds plus long-term liabilities will give you your capital employed. Will give you your capital employed. Your shareholders' funds plus your long-term liabilities will give you your capital employed. Your capital employed can also be calculated as total assets minus current liabilities. So your total assets minus current liabilities should also give you your capital employed. Always remember this. Shareholders fund, which is equity, long-term liabilities, which is long-term debt, will give you your capital employed. Will give you your capital employed. I hope it's clear. And to calculate ROC, there's also another twist to the formula that you can use. And that's the beauty of ratios, right? So your return on capital employed is simply your profit margin times your asset turnover. Your profit margin times your asset turnover. So basically, what is your profit margin? Your profit margin is your profit divided by your sales. Your profit divided by your sales revenue. Your asset turnover is your sales revenue divided by your capital employed. Now, if you multiply these two things, you will get your return on capital employed, which is your operating profit divided by your capital employed. Very, very important. Very, very important. What it means is that you are canceling out revenues. You are canceling out revenues. Let me show you this real quick. So you see, you have PBIT here divided by sales revenue times sales revenue divided by capital employed. So if you take sales revenue out, this sales revenue will cancel this sales revenue. And then you have PBIT divided by capital employed. This is a denominator, this is a numerator, so they can cancel out each other. So at the end of the day, you have operating profit divided by capital employed, which is your ROC. Very, very important. Yeah, so that is your ROC. It's a very, very important tool. Very, very important tool. Then you have other profitability ratios, which is return on equity, which is your earnings attributable to ordinary shareholders divided by your equity. You have your gross profit margin, which is your gross profit of your sale over your sales. You have your net profit margin, which is your net profit also divided by sales. Then let's move on to your shareholder investment ratios. You have your dividend yield, right? You have your dividend yield, which is your dividend per share divided by ex-dividend market price per share. Always remember that you need to use the ex-dividend market price per share. You have your earnings per share, which is equal to your profits attributable to ordinary shareholders divided by your weighted average number of ordinary shares. You have your price earnings ratio or your PE ratio, which is your market price divided by your earnings per share. So let's take a question. A question will make it a lot relatable. So this is a simple question. A company has recently declared a dividend of 12 cents per share. The share price is 3.72 cum dividend. Cum dividend means before dividend payments. Ex-dividend means after dividend payments. So cum dividend and earnings for the most recent year were 30 cents per share. Calculate the PE ratio. Always remember that when you're calculating the PE ratio, you need the market value ex-dividend. Always remember that, ex-dividend. So if you have the cum dividend, you need to take out the dividend portion to get to the ex-dividend. So what is the market value ex-dividend? We need to find out what is the market price or share price cum dividend. It's 3.72, right? Then the question says, a company has declared a dividend of 12 cents per share. You can see it right here, 12 cents per share. So you need to take out that 12 cents per share. You get 3.6. Then you divide that by your earnings per share, which is 30 cents. So you should get 12. You should get 12. So your PE ratio is 12. Always remember that you need to use the ex-dividend market value. Ex-dividend market value. Please keep that in mind. Please keep that in mind. Let's move on to the next slide where we talk about incentivization. Incentivization, you know, as part of financial management, one of the things you need to think about is incentivization and encouraging the achievement of financial objectives and stakeholder objectives. So it is usually argued that management will only make very good decisions if they are monitored and appropriate incentives are given. You know, generally, that's how human beings behave. You know, the agency relationship, which we talk about in our strategy class extensively, arises from the separation of ownership and management. So we know that the owners are the principal and the agents are the managers. The principal contracts the agents to do some work for them, basically to serve their interests. So owners hire managers in order to work for them, to serve their interests and ensure the growth of the firm. So the agency problem arises when, you know, there's a clash between the interests between these two parties, owners and managers. So we need to ensure what is called goal congruence. Goal congruence is basically the agents who are the managers acting in line with the organizational goals. They are not acting for their own selfish interests, but they are acting in line with the organizational goals. So what are the examples of remuneration incentives? What are the examples of remuneration incentives? There's performance-related pay. You know, you can give some payouts based on performance. You can also reward managers with shares as well. And you can also have what we call executive share option plans. Executive share option plans. What are executive share option plans? It's basically a share option scheme where selected employees are given a number of share options, you know, which basically the employee has the right after a certain day to subscribe for the shares at a fixed price. So you give company shares to a group of employees who have the right to subscribe it at a fixed price at a certain date, basically. So that is executive share option plans. Executive share option plans. It's basically you are giving shares to employees who have the right to, you know, subscribe to it at a certain price or at a fixed price. Then let's move on to what are the benefits and disadvantages of these incentives, because we need to know that. The benefits are that, first off, you need to know that performance-related pay may give the benefits an incentive to achieve good performance. It can drive performance. Yeah, it can drive performance for sure. So schemes that are based on shares can also motivate employees. It can serve as a source of motivation because once you are giving people incentives, you know, it motivates them to do more. And you can also use incentives to attract employees. So, for example, people change jobs because of the incentives. People change jobs because of incentives. Then what are the disadvantages? It can result in dysfunctional behavior. It can result in this dysfunctional behavior. What do I mean? So managers can, you know, pad their budgets. You know, they can pad their budgets just to make their variances look a lot more favorable. You know, they pad their budgets, make their budgets look huge, just to make sure that they make their variances a lot more favorable, And this is, you know, dysfunctional behavior as a result of incentivization, because people just want to get the money, get the check. So they would use every means, and one means is padding the budget. The second thing here also is that it may result in interested performance. When you do a lot of incentivization, you must make sure that it does not lead to, focus on self rather than the teamwork. So if people are always chasing the incentives, then it's about them and not about the organizations, and it becomes, very, very dysfunctional for the organization in that regard. Incentives, you don't want people to focus so much on them, just them getting the incentives. You want them to focus on the entire organization and the team, And usually incentives that are designed to achieve long-term goals or purposes may not necessarily motivate employees. You know why? Because people don't want to stay in organizations for long. These days, people switch from organization to organization. So if you have a scheme or an incentive scheme that seeks to ensure long-term goals or promote long-term achievements, it may not motivate people because they do not want to stay with the organization for 10 years. After 2 years, they want to leave. After 4 years, they want to leave. So that's also a disadvantage. Then let's talk about not-for-profit organizations and value for money. When it comes to financial management, very, very important when it comes to not-for-profit organizations. Not-for-profit organizations do not exist their primary purpose is not to make profit, but certainly they are funded by donations, and so they need to manage their resources properly. So they manage their resources with a concept called value for money, which means you are getting the best possible combination of services from the least possible resources. So basically, you are maximizing your benefits at a very, very low cost. Value for money. You are maximizing your benefits for the least possible cost. Value for money. Maximizing your benefits for the least possible cost. So there are costs. So there are three key things when it comes to value for money. Number one is economy. Number two is efficiency. Number three is effectiveness. Never forget this. The three E's when it comes to not-for-profit organizations' financial management or value for money. Number one is economy. Economy means spending money frugally. Spending money frugally. So you can also explain it as attaining the appropriate quantity and quality of inputs at the lowest cost. So it's all about low cost economy. Just like the economy section of an airplane, low cost, spending money frugally. Then you also have efficiency, right? Efficiency is getting out as much as possible for what you put in. Getting out as much as possible for what you put in or what goes in. So it's basically the relationship between inputs and outputs. Inputs and outputs. So I'll show you a simple trick to remember all of this. Then you have effectiveness. Effectiveness simply means getting things done by employing the principle of economy and efficiency, to get what was supposed to be done. It's basically the extent to which you meet your goals and objectives. The extent to which you meet your goals and objectives. So these are the three principles, but I'll show you a simple trick. And you would remember this. So when we talk about economy, we are looking at inputs, that is low cost. When we talk about efficiency, we are looking at the relationship between inputs and outputs. When we talk about effectiveness, we are talking about outputs. So economy, inputs, efficiency, the relationship between inputs and outputs, and effectiveness, we are looking at outputs. So that's how an easy way to remember it. Economy, we are looking at inputs, which is low cost. Efficiency, we are looking at the relationship between inputs and outputs. It means that what you put in, you should be able to get out. What you put in, you should be able to get out. Getting out as much as possible for what goes in. So efficiency, you are looking at the relationship between input and output. Effectiveness, you are looking at output. You are looking at achieving your output, achieving your goals, achieving your objectives. So basically, that is value for money. Value for money. And not-for-profit organizations focus a lot on value for money and managing their financial resources. So that's very, very important. And thank you. This is a brief lecture that I wanted to add for you to understand, because it's critical for you to pass your financial management exam. And so if you haven't subscribed to this channel, please do so that anytime I post a video, you'll be the first to get it. Just hit the subscribe button and hit the notification bell so that anytime I post a video, you should be the first to get it. Thank you very much and have a good day.